And I think the inflation's absolutely real. If anything, I think the headline numbers that we see somewhat understate the actual inflation, in large part because of the shelter component. So it's kind of a wonky way for them to calculate it, and it somewhat understates and smooths out changes in house prices compared to how it used to be calculated. And so I think, the quote unquote real inflation is probably at least in the low double digits. So, kind of a few hundred basis points higher than it is now. But of course, everyone has their own, individual inflation basket because they all have their own, different things that they buy on a regular basis, the different weightings that they assign in their daily life. So there's no kind of one inflation metric, but I think if we were to have kind of a more consistent reading, we'd be at a slightly higher figure. That being said, we are seeing evidence of disinflation starting to materialize, meaning that inflation might be cresting and then kind of stabilizing at least for a period of time. So you could get disinflation doesn't mean deflation; it just means less inflation, like less rate of change. And so the way I would describe it is that the supply side remains largely unresolved. We basically have various supply side limitations, especially as it relates to energy and commodities. But there's the demand component, and by tightening up fiscal policy to kind of in an intermediate way, and by tightening up monetary policy, they're basically taking some of the demand off. But that essentially means a recession. Another thing that I think people have to keep in mind is that the Strategic Petroleum Reserve is still being drawn down, and that's still expected to continue for a little while longer, and so that's putting somewhat downward pressure on oil prices. So I think right at the current time, I think we hit kind of a fever pitch in terms of inflation, and now that it's rolling over somewhat. But I think that the problem is that it's kind of like holding a beach ball underwater. It's ready to return as soon as they kind of let go of some of those levers. And of course, there's other variables too. We have to see what happens out of China, right? Because China is a huge demand source for commodities and energy, and they're showing weak economic data as well. Obviously, the one spot where there's still huge inflation risk more than anywhere else is probably Europe, because they have the most severe supply side limitations. But I think that's kind of where the data is pointing at the current time. So I think that there's reasonable criticism that they're kind of drawing it down for political reasons, that it's not an actual crisis, and that they're basically suppressing prices leading up to the election. I think that's a reasonable criticism. Whereas, for example, what's happening in Europe is more of an actual crisis. In the United States, we have high energy prices. In Europe, they have crisis level energy prices. The other part, though, about selling it overseas, that one I think is more straightforward in the sense that, my understanding of the way that reserve works is they have, when they choose to draw it down, they have to sell to the highest bidder. And it just so happens that some of these bids, China was the highest bidder. Now, on one hand, commodities in general, except for natural gas, because it's so the costs are so much in transportation, but certainly in oil, it's a relatively fungible market for the most part. And so if you have demand anywhere in the world, that's going to trickle through global prices. And so I still think that them selling to forwarders actually does put some downward pressure on domestic prices as well, because it's a fungible market. Now, that still could be a separate matter from whether it's a good idea to draw down the reserve or not. I think it's probably, not. But I wouldn't put them as like the motive of, say, trying to say just push down foreign prices. I also think if you look at polls, for example, if you ask people what is the biggest concern facing them, inflation will be, at the top, and then like high gasoline prices, which is another way of saying inflation, is like, number 2 or 3, and then high rent prices, which is another way of saying inflation, is also like, 2 or 3. And so I think they have a legitimate interest in pushing down energy prices in the intermediate term, because they generally want that to be reflected in how the vote goes. Because if they go into the election with like $7 oil across the country, I think that's going to be a lot harder for them than if they go into the election with $3.50 oil, gasoline, for example. So that's kind of how I'm analyzing that situation. So I think they can take action around the margins, and I think we're seeing that show up in the housing market, for example, how that impacts mortgage rates and things like that. This partially from private market forces and then partially from those kind of more central forces. And I think basically they have a number of tools to kind of rein in demand, and in their view, they want to try to use them moderately. But of course, if you look at the historical track record, soft landings are rather rare in U.S. economic history, right? Usually they tighten into a recession because they, during the loosening phase, they basically encourage debt accumulation, and then they tighten the screws on anyone that actually took out debt in that environment. And so I think we're seeing that play out now. We're seeing a cooling off in the housing market. We're seeing some softness in the labor force around the margins, at least. So especially when you look at initial jobless claims each week, labor force participation, job openings. Ever since March 2022, we've seen kind of a softening in there. And so I do think it'll be quote unquote effective around the margins for, temporarily reining in inflation. But I think it comes at the cost of either significant economic slowdown or an outright recession. And I think that's kind of sort of the environment they're in now. My kind of base case is that, so we've had 2 quarters in a row of, negative real GDP growth. It's a little tricky because we came off such a sugar high. And so, for example, most recessions, not all, but most recessions, they also go, negative year-over-year real GDP. We haven't hit that threshold yet. That's kind of like another arbitrary threshold. The very mild 2000s recession actually didn't quite hit that either. But so far we have not kind of reached that threshold. But I think that if this kind of trend continues, I think we can kind of trend in that direction. And you could certainly have a kind of a, like a double dip recession where you have, say, 2 negative quarters and then a slightly positive quarter and then another negative quarter. And you can kind of bounce along this weak path. But so far the data is still deteriorating. Basically rate of change data is still showing overall kind of weakening prospects. When you look at PMIs, when you look at producer prices paid, basically we're seeing a disinflationary impulse, but not really for good reasons, more so due to the demand destruction rather than the supply constraints easing. So I think that'll be a multi-year story. I don't think that's going to be kind of a price driver in any kind of one single quarter, but I do think that that's going to be a pressure, a negative pressure that was not there in the prior stage of demographics. Another thing I'm looking at is, at the end of 2021, if you look at stock market capitalization to GDP, it got up to around 200%. If you look at, for example, the Wilshire 5,000 compared to GDP, and that was a record high when it reached that level. And you had a combination of interest rates were driven down super low. You flooded the market with stimulus, and I think that was probably a high watermark that we're not going to see for quite a while. And that doesn't actually mean that the stock market can't hit nominal new highs, but I do think that the stock market relative to GDP has probably hit, kind of pretty structural highs. It's hard to envision a set of forces kind of bring that up again, because that was kind of the culmination of 4 decades of falling interest rates all the way down to zero, and then you had that absolutely huge kind of fiscal and monetary impulse together. It was kind of the end of a long-term disinflationary cycle. You had oil go negative, so there's no, at the time there was no pressure from commodities until kind of the end of the year. And so I think that's a risk I'm looking at, is that whether or not we hit nominal new highs, I think that forward, say 5 to 10 year returns for the S&P 500 in inflation adjusted returns are going to not be great going forward, because I think we're in more of that kind of sideways band going forward.